Every central bank in the world is watching something right now most people are missing. The country that built the entire global financial system on exporting dollars can no longer find buyers for those dollars. Foreign demand is collapsing, and at the same time, gold is physically leaving US vaults at the fastest rate in over a decade. The biggest buyer left, the EU, just held an emergency meeting about using their treasury holdings as leverage over the US. Central banks understand what this means. Sovereign wealth funds understand what this means. The people managing nations' money are already repositioning. Understanding this is a key piece of the puzzle for navigating 2026 and beyond. So, let me walk you through it. This video is for information and entertainment only. It reflects my personal opinions and is not financial advice. Check the description for more information. Always do your own research. So here's the problem. The US used to export dollars. Now it's begun to export gold as its primary export. The buyers of dollars are leaving and the buyers of physical gold are increasing because the world is no longer buying US debt like it used to. Instead, they're buying gold, right? Instead, they're buying hard assets. Now let me break down what all of this means. So who's still buying US debt? Well, China have been a net seller since 2013. They've also recently announced that they want to be completely out of US debt just last week. Russia liquidated basically everything after the war in Ukraine. Now, potentially they might be re-entering dollar-based settlement to try and pull some leverage over the US. I don't really think this is a cap in hand Russia necessarily. There might be some untoward ideas around this, but you can see, right? Japan were the largest holder of US treasuries. The Bank of Japan held a bunch. They are not going to be buying anymore because essentially the Japan carry trade has unwound. If you don't know what that is, I'm going to explain a bit later, but fundamentally you used to be able to borrow money in Japan for free and then invest it in the US so you could earn the spread on that. Now, Japanese borrowing rates are going up. So there's one last strong buyer of US treasuries. This is Europe, right? The European Union. Everyone else is basically exited or in the process of exiting. And what we're seeing now, though, is that Europe recently held an emergency meeting to say, look, we are prepared to use leverage over our US holdings. And Europe hold a lot of US treasuries, a lot of US stock, and a lot of US corporate bonds. They hold about $10 trillion in US held assets. And they had this anti-coercion meeting, right? Which basically said, look, we're willing, this was last month, to use our holdings of US treasuries and equities as leverage to not be bullied like they were in the Greenland situation. And what this means, right, is that there was a study that was done a few years ago in 2022 that tried to analyze, okay, if a country or if an entity sells $100 billion of US treasuries, how much does this change the price of yields? Because they work inversely to normal supply-demand dynamics. When more people want to lend money to an entity, that entity can demand a lower interest rate. Think of it like your credit score. Let's say you've got a really high credit score, you've got 700 credit score. You can go out and get credit cards from lots of entities that are willing to lend money. That means you get a lower interest rate, more option, lower rate. If you had a really bad credit score, let's say you got bankrupt and you only had one provider that would give you a loan, suddenly the rate goes up. It's exactly the same in the global bond markets, right? For the government to borrow money, it's no different. If the government want to borrow money and they have lots of people willing to lend the money, they get a lower rate. This means yields come down when that country's debt is in demand. And the reverse happens too. Yields go up when that country's debt is not in demand. There isn't many people or isn't many entities to want to lend money. Now this is important because if we look here, there was a study done in 2022 that looks at if $100 billion in treasuries are sold, in US treasuries are sold, this increases the yield by about 19 basis points. So Europe holds $2 trillion in US treasuries. If they sold 20% of those holdings, they'd increase yields by roughly 80 basis points. That's an enormous amount. It would take yields from roughly 5% where they are right now, all the way up to sort of 5.8%. And this would have a big impact on mortgages, credit card debt, basically everything that real economies work upon. This is not going to affect the Fed funds rate, and actually this is much more in line with the real borrowing costs in an economy. Now, it's not quite so simple. If Europe just used their treasuries as leverage over the US, well, it would actually hurt them somewhat too, because they hold these assets, right? However, they have announced they will be willing to use it as leverage. Now, why is this important? Because gold is also leaving the US. Okay, so non-monetary gold, which is basically all gold that isn't in little coins, right, has been leaving the US at one of the fastest rates of all time. In Q3, $20.6 billion was exported. In October and November, gold was the #1 export from the US. This means America basically settled part of its trade deficit in gold. So the country that prints the reserve currency of the world is actually exporting less of the reserve currency and more gold. This tells you basically the world only really wants gold from the US, not dollars. This is a really important seismic shift. Yes, obviously gold price went up 74% last year, so you could argue that the dollar amount is different, but if you look at it in tons as well, actually the US exported 268 tons of gold last year, and it only mined 160. So we've got a net export of gold in the US, and the route is quite clear. The US exports this gold to Switzerland. Switzerland is the world's biggest refinery for gold, and then that gold gets packaged up and sent out to the east, right? China, India, Turkey, the UAE. These entities are literally buying gold from the USA. The US is exporting gold, not dollars really, because remember, these entities are decreasing their dollar buys and they're increasing their gold buys. All right, so we know gold is leaving the US, okay? Now, gold at $5,000 looks expensive. It's had a ridiculous run up, but if we look at gold in terms of debt, suddenly it's not actually that expensive, because what you can see today is gold as a percentage, okay, of foreign held debt is 14%. Now, the 60-year average is 50%. What does that mean? It means that of all the debt in the world that is held outside of the US, right now, gold is only worth 14% of that amount, and the 60-year mean is 50%. There's been times that it's been much higher, 130%, for example, in the 1980 crisis, and 20% around when the Berlin Wall fell. So you can see right now today, gold is worth much less in terms of the US's national debt. Now, why is this relevant? Because the dollars are obviously worth loads less. There's loads more dollars in circulation. They've all been pushed out via the debt-based economy that we live in. But gold hasn't really moved in unison with that. Now, yes, it's had a really, really good year last year, 2 years, but it's still well behind its historical averages. It doesn't mean you should go and buy gold today, obviously not. This is saying, look, based upon the fact that US debt has been exported so readily and people were willing to take it on, gold hasn't really gone up in line with that insatiability for US debt. But it looks like something over the last 2 years is beginning to change, right? Because America owes the world 27.6 trillion. What does this mean? It means that the rest of the world owns about 27 trillion more than the US owns of the rest of the world. Now that's fine. The US has been exporters of, as we've seen, treasuries, stocks, because they've had the best businesses in the world and they've had the world reserve currency. Completely reasonable. However, what this means is right now, a strong dollar makes all this worse. This is why it matters. If the dollar strengthens, foreigners owe more in local currency to maintain their current positions. Now, this forces people who hold dollars to sell those dollars. This ends up pushing yields up, right? Because we've seen as people don't want to hold debt of a certain individual or certain entity, that means that debt gets more expensive for that entity. Higher yields mean it's even more expensive to pay down that debt, right? This is why Trump wants rates to come lower. And you get into this death spiral of people needing to exit because they need to sell their assets to cover their own back, but this forcing US yields higher, which obviously makes the US debt crisis even worse. So it's really important that the US doesn't have everyone exit their assets, because it would make the debt crisis 100 times worse. And this is one of those things where the US needs a weaker dollar, because otherwise they could have this complete runaway death spiral inside their currency. But there's even more fragility inside the US debt market, right? Because an enormous portion of US debt is held in the Cayman Islands by a bunch of hedge funds. Now, what's specific about these hedge funds is that they take US debt and they lever it up, 20 to 1, 50 to 1. So their actual holdings are in the trillions, but what the data says is it's in the billions. And 37% of all treasury notes and bonds issued in 2022 to 2024 were absorbed by hedge funds in the Cayman Islands. That's enormous, and that's so important because if a negative death spiral begins to unwind, right? If you're levered 50 to 1, you must get out of that trade quick or your entire account's going to get blown up. So US Treasuries are the pristine collateral for global trade. Oftentimes you can borrow 20 to 1 against US Treasury. So if you've got US Treasuries in an account, let's say you had $100 in Treasuries, you could borrow $95 against that $100. That's a very common levered up strategy that Treasuries are used for. If that's the case and suddenly rates turn against you, you're going to be a seller, right? You have to be a seller, you have to get out of that trade. And this again pushes yields up in the US and creates even more of these issues of runaway, sort of like death spiraling issues. Now, obviously the US is very, very unlikely to go into a death spiral. I'm not saying that we're going to see some crazy death spiral. Don't get it twisted. What I'm saying is there is a clear seismic shift from US collateral is the most pristine, everybody wants it, to suddenly, it seems like what most central banks want across the world, what most governments want across the world, is suddenly harder assets. And again, this is why it matters, right? Because if any foreign entity sells US Treasuries, as we saw above, $100 billion in selling, this is by a study from 2002, equates to roughly a 19 basis point increase in the 10-year yield. So for every $100 billion of US Treasuries that are sold, we see a spike in yields by about 19 basis points, or 0.19%. Now, this is what stress ends up looking like. If suddenly you got to sell $750 billion of treasuries, which is what happened in 2020, right? Yields spike egregiously to the upside, which is a big problem. And this was going on before all the sort of Cold War, geopolitical tensions that we're going through right now. Okay, so what proves this wrong? What says US Treasuries are not in decline and the globe still wants them? Well, one of the first things is that Europe is still buying, right? Europe is still a net buyer of US Treasuries, so it's not all doom and gloom yet. Selling hurts the entity that holds it in the short term too. Like, Europe doesn't want to have to dump all these treasuries because it will have a big impact on their own holdings. Other European debt is pretty terrible. No one really wants French debt. No one really wants Italian debt. These aren't like global exports. So where are they going to put that other $2 trillion? They can't just dump it all into gold. And the gold surge in price may be, some COMEX or London Metal Exchange arbitrage and front running of central banks. Not necessarily this sort of like shift to gold as a reserve asset and monetary asset, but it does look like there's a decent move towards gold right now. And when you consider that gold on average is only 2% of the average portfolio, you can see that most people are not positioned for gold being a central portion of like global trade once again. Dollar demand as well is still enormously high. No one is saying that dollars are not going to be the world reserve currency. Even if this goes wrong, it's still a very, very long way away for the gold to be a reserve currency. Yes, in China, they are very close to creating a new currency that is backed by gold. So we're already seeing the sort of etchings of this happening, but I don't think that global trade is not going to be settled in dollars anytime soon. The key here is that the dollar as the key exporter from the US may be changing, and it looks like gold might be coming in its place. Not that global trade won't be settled in dollars. I mean, central banks are clearly showing you the path, right? US Treasuries are going like this, and gold is going like this. Now, central banks are not the only people in the world that matter, but central banks, sovereign wealth funds, these entities are definitely increasing their exposure to a neutral reserve asset away from the one that is essentially being inflated and going asymptotically to zero. And this is also important to note, right? Because gold versus the SPX over 25 years, 10 years, 5 years, 2 years, 1 year, has outperformed it. Just think about that. Some random, useless, essentially, rock that you dig out of the ground that's shiny and a bit soft has outperformed the best companies in the world over the last 25 years on basically every time frame that matters except 15 years. So look, over 1 year it outperforms, 5 years it outperforms, 10 years it's outperformed, 15 years SPX has done better. This is with dividends reinvested, mind. So this isn't even notional performance, this is with dividends reinvested. Over 25 years, gold has swept the floor. Now, you could choose any time frame and you could cherry pick and say, look, the SPX has done better over this time, and you'd be reasonable in any time frame that you chose. It just highlights that actually recently gold has clearly been something that we are moving towards, especially with its performance over the last 5 years. So what does this mean? It means that yes, stocks went up over the last 25 years. Obviously, the US market has been incredible. The returns have been great, but a useless rock that's dug out of the ground has done better than the US economy at large. If you'd have just held that, you'd have done better. So in real terms, in the one store of value, which is typically considered to be the global store of value, gold, stocks have basically gone nowhere for 25 years and actually have lost in real terms. And last year was obviously a really good year for the SPX, 17% up, and actually went down in gold terms. You know, you basically lost 25% in purchasing power in gold terms, which is kind of crazy when you think about it that way. So the question is this commodities run? Is it finished? Is it going to continue? Well, I think there is a very strong case to be made for the continued run of hard physical assets, real assets, atoms in this space, right? So things like commodities, gold, precious metals, energy. These things tend to do very well. Again, in midterm years, they tend to do very well. Is there going to be some transition into the digital store of value, Bitcoin, at some point? Personally, I think there is a very strong case to be made for Bitcoin to act as a credibly neutral store of value that captures some of gold's market cap over time. I think it probably continues to eat away at gold's market cap overall, but doesn't mean it has to go up today. Like right now, about 13 ounces of gold buys you 1 Bitcoin. We could easily see, 10 ounces of gold buying 1 Bitcoin. We could easily see the gold Bitcoin pair continue to bleed. My assumption though is that Bitcoin has made higher highs and higher lows against gold throughout all of its history. I think that trend tends to continue, but right now the baton is in gold's hands, and it's likely to continue, especially with all of the underlying reasons that I've given you today for why gold has been moving so well. And so there are a few things to watch to just check whether this thesis is going to continue to play out. First of all, we've got more data coming out pretty soon. On the 19th of February, it's going to tell us, was more gold purchased at the end of Q4? We've also got trade policy agreements that we're going to see between the US and the EU. As more of this data comes out, as more ideas come out, as more pressure comes out, we're going to see what's happening to European holdings of these US Treasuries. The one thing that we can keep an eye on is just the spread between government debt in the US, so bonds that are really far out in the future, and ones that are much more short, so between the 5-year and the 30-year. If the difference between the 5-year and the 30-year continues to go up, i.e. costs lots more to hold debt for a long period of time than a short period of time, this says that we are less certain, we don't think you're going to repay your debt as well over a longer period, then again that's going to show that people are continuing to demand higher premiums for long durated debt, which is what should happen really. And so the key takeaway is just to keep watching what these central banks are doing. They're continuing to acquire hard assets and potentially even move away from the US dollar. What does this mean? It means that you can only hold hard assets because the US debt burden is likely to increase, especially if there's less buyers for this US debt. Now, interestingly, there are more shorts against US debt than ever before. So that looks like a crowded trade at the moment. We can go through what that looks like in a future episode if you want. I actually am not super bearish on US government debt in the short term, in the next 3 to 6 months. I'm actually not that bearish on US government debt. I am very bearish on US government debt over the next 5 years. Unless we have an incredible deflationary hit from AI, which definitely could happen, I think holding hard assets here is the one thing that I'm going to be making sure I do regardless. Anyway, thank you ever so much for watching, guys. If you got some value out of this, please consider liking and subscribing, maybe even sharing it with a friend. That helps more than you know. Otherwise, I hope you have an excellent day, and I shall see you in the next one.